Well, perhaps it's no surprise that as Canadians put more money towards paying down debt, they've got less to spend elsewhere. But a new report from TD Economics quantifies the effect renewing at higher mortgage rates is having on spending. Let's bring in James Orlando. He's director and senior economist at TD on this new report that he put out. Thanks so much for joining us today, James.
Yeah, thank you for having me.
So I wonder if we could start sort of where you started in the sense of where Canadians were at with their debt levels heading into these rate hikes, because I thought you had an interesting comparison between Canadians and Americans.
Oh, yeah. So we all know that Canadians love housing, right? When you look at how much house prices have gone up in the last few years and the need for housing, the fact that people wanted to be able to jump in, make sure they can actually, get a house that they require, the amount of debt that Canadians have taken on is about $2.9 trillion. So we have a lot of debt in Canada, and we're spending about 15% of our incomes right now just to service that debt. Now, compared to what happened to Americans before the financial crisis, closer to about 12%. Now, that was before they went into the financial crisis. So obviously, it's a difficult comparison. It's a worrisome comparison when we look at where Canadian households are right now, and especially when you consider that mortgage interest rates are rising. So as we go through time, as mortgage rates continue to rise, more and more Canadians will have to allocate more and more money. So it puts people in more of a precarious situation.
Yeah. So what have we seen so far? There's a few different cohorts that you looked at here, James, because, I mean, we know that Canadians have shorter mortgage terms than the Americans do as well. And so they do need to renew the typical mortgage term being 5 years. But, it happens in a staggered manner. And so when you're thinking about consumer spending, what Canadians are able to spend on their, day-to-day needs and wants versus what they need to be paying towards their debts and their mortgages. How have you seen that play out in the data for mortgage renewals that have already happened in the past couple of years?
Yeah, and that's really the question. That's what we were trying to dig into, because, we keep seeing the economic data, the broad economic data, that consumers are becoming more and more hesitant as interest rates rise. And, that's all well and good. But what we were able to do is we were able to follow, using credit card and mortgage data, people through time, consumers through time, and we're able to separate them based on people that don't have a mortgage, people that have a mortgage that renewed in, say, 2021, those that renewed in 2022, 2023, and those that will renew in 2024. And so what we found is that people that don't have a mortgage have actually been able to increase their spending over the last 12 months. Whereas people in 2021, when they renewed, they've pulled back their spending just a little bit. And the interesting thing is that as you go through time, the 2022 and 2023 cohorts, these people have started pulling back spending even more, logically, because they have been experiencing higher and higher mortgage rates. So what this means is that as rates rise, we're actually able to figure out exactly how much people have pulled back their spending based on when their mortgage renewal was. But what's even more interesting is that we also have data on the people that will renew in 2024. And so when we follow that group over the last 12 months, they have pulled back a little bit, but pretty marginally. They actually haven't pulled back too much. And this is maybe a little bit of precautionary savings in the sense that they know that they're going to have a big mortgage reset next year, potentially. And so what that means is that because they haven't pulled back their spending as much as, say, the 2023 group of people that reset their mortgages, it means that spending for them is set to decline most likely in 2024 when they actually have to go through that experience of resetting their mortgage rate.
When you talk about the pullback in spending, when you're looking at the 2021 cohort of it being less than 1% of a pullback, almost 1.5% for those in 2022, and about 2.5% for those in 2023. I mean, it sounds like it could be small, but that really adds up, doesn't it?
It's a huge amount, actually, when you put the numbers together. Like, for example, when you think about what recession is in Canada, like what a recession would look like, it's people pulling back spending. And they don't actually pull it back. They're not cutting spending in half. Like there's people are still living, they still need to spend money. But what it is that when people pull back spending, it amounts to about $6 billion is what we calculated so far. And that's less money for people to spend on other things that they would have spent, buying TVs or buying groceries, whatever it might be. And it means less profits for businesses. And so that also means that businesses are getting less profits than they otherwise would. Maybe they don't hire as much. And if we're right, and we're seeing these people that in 2024 and potentially in 2025 having to pull back their spending, that's a whole another cohort of people that would have to pull back spending, and less profits and less opportunities for businesses as well. So I think this is it's broad in the sense of when you look at these numbers, yes, they might not pop out on the page, but they add up to real dollars for businesses.
What do you think, when you're looking ahead to 2024 and this potential that this, cohort of the year would be pulling back even more on the spending, adding to that $6 billion pullback? What does that end up meaning for the economy, do you think?
Well, I think this is one of the reasons why people have been guessing and forecasting that the economy is going to go through this time period of weak economic growth. People just don't know how weak it's going to be. Now, sometimes people pull back spending based on the fact that they're worried about the future. Some people pull back spending based on what we're showing and based on the fact that they have to because they have to spend money on other things. Now, for us, we always thought 2024 was going to be a weak year. We're already in an economy right now which is trudging along this zero growth line. We had a negative print in Q3. Q4 is looking like it's going to be somewhere close to 0.5% maybe. Now, those aren't really strong numbers for the Canadian economy. And this is the reason why we're probably going to be going through this early 2024 time period where growth is going to be around that zero line. And that's not much buffer for error in case something else happens to the economy. And this is one of the reasons why, I think a lot of people are concerned about how 2024 is going to look. You look at our forecast, we have the unemployment rate continuing to rise through all of 2024. We have job losses coming through. And, if you talk about mortgages being or mortgage renewals being a factor that's going to slow spending, job losses and a slow labor market's another factor that would slow spending.
Right.
So I think the magnitude in which we're talking about right now, yes, we haven't seen the full brunt of any of these factors coming through just yet. I guess we're on the sort of more of alert and more watching cautiously as we see how everything unfolds, because we've known for a long time that high interest rates are going to weigh on the consumer. We just didn't know how much, and we really haven't seen the full effect of it just yet. And I think that's the story that I think is most important here, is that we haven't seen the full effect of higher interest rates on the economy just yet.